At one end, it was a bonanza policy. They've come back and delivered a mega 50 basis points rate cut. They've also come back and delivered a 100 basis points CRR cut to commence from September over the next 3 months thereof. In all, I would say this is more like a north of 75 basis points rate cut. So it was a very big boost from the rates perspective. But on the other side, they came back and disappointed the markets, saying that they are changing the stance from accommodative to neutral. They've come back and said that there is very limited scope for RBI or the MPC to come and support from the rates perspective hereof. So the rates are now pretty much anchored at 550. And some of us, like other market participants, thought in this cycle the rates could have been as low as 5, maybe 5.25. So that was a little bit of a dampener, and the bond markets clearly gave their verdict. After a brief rally on a net, the rates sold off. They were higher for the day, and while we speak, the 10-year is closer to 635. So obviously this has been seen as a net negative. So why did RBI do that? I suspect that it was to protect the currency. They're a little afraid that with the excessive rate cuts, with the interest rate differential coming down, the currency may take a beating. And somewhere down the line, maybe the excessive or the high foreign exchange short book that they have, which they probably want to unwind. That is something that is playing in their minds as well. So I suspect that they basically come and said, here's the deal. This is big amount of rate cut that we are delivering over to the banks hereof to take care.
And it was significant. We're talking about 2.5 trillion rupees injected into the system through the CRR reduction, right, Tanveer? That represents one of the largest liquidity infusions in recent years. And I believe, please correct me if I'm wrong, that the last time we saw this type of action of this magnitude was post-2008 financial crisis.
Absolutely.
By that metric, does that concern you? Does that suggest that there is something troubling on the horizon that the RBI perhaps want to preempt in the domestic economy?
No, I don't think there is any worry per se. But yes, we too were surprised with the magnitude of both coming together, right? Just not the CRR, but also the rate cut. Having said that, of course, it is prospective. It is not overnight. It is in a phased manner. I think what the message the RBI is giving is that liquidity was a constraint towards the end of 2024 and early 2025. Since then, they've come back and handled it very comprehensively. We already have been hovering around the 1% NDTL often take in the recent past. And with this, the durable liquidity should be north of 2, hovering closer to even 3% over the next few months. So I think basically they are ensuring that the liquidity is ample so that there is no reason for non-transmission of these rates. I don't think they are really worried at this point of time.
I see. So tactically, Tanveer, post-RBI, knowing what we know, does short duration make sense?
Yes, absolutely. I mean, with the rate cut cycle supposedly come to an end, there is lack of duration play at present, one would say. But I wouldn't write off duration altogether. What one must see is if you dial back a few years ago, RBI had indicated that the comfortable neutral real rates of around 1.4 to 1.8, 1.9%. And if we take the projections of 3.7% inflation for the year, and against that, when we look at 5.5%, we are at the upper end of this neutral real interest rate. So as such, RBI does have the capability to cut rates. The bar is much higher. Yes. I think there will be multiple cues that we have to look at. One is for now, when you look at the US real interest rates, they are also at similar levels, right? If you, for instance, if you take core PEC hovering around 2.5% versus 4.5% for the Fed rate. And as this inflation were to edge up, which we do expect, maybe if their economy came in slower towards the end of the year and they had a few rate cuts, as that number goes down, that will give some additional leeway to RBI. Lastly, let us not rule out that there are some sectors of the market, some economists who are actually projecting CPI to go to as low as 2%.
Yes.
So there could be some more scope, but the bar is high for sure.
Understood. Tanveer, there's been a fair degree of interest domestically in corporate and MBFC bonds. What is that telling us? And just how compelling is the risk-reward proposition in this space of the fixed income market, of the bond market?
I think, there was some sector restrictions earlier on the NBFC space, and which had been eased subsequently. Credit growth had come down from the 14-15% to 10% and is expected to pick up. With interest rates going down at the margin, that's going to give some bit of leeway for the borrowers to continue to come and borrow. So there is a little bit of, from the one point of side, there is a little bit scope for further credit growth. From the investor's perspective, given that duration has been a difficult play, both India and globally, it does make sense to be in the front end, in which case you go for the additional carry and you go and lap up this additional supply that is coming from this segment of corporates.
Understood. Thank you for that, Tanveer. So foreign ownership, as I understand it, of Indian government bonds is still on the relatively low side. So how does this perceived front-loading by the RBI, if it is a positive catalyst for foreign investors, how does that change the narrative from foreign inflows positioning point of view into the Indian bond markets?
So there is no doubt that at the margin, given that the lack of immediate trade in duration in India, foreign investors are unlikely to be so-called, let's say, trade or punt on the Indian bond market. So at the margin, their demand is going to be lower from that segment. We have previously discussed, and we all know that India has been included in global indices. So from the benchmarking perspective, as the other indices get included, like the FTSE as well, there will be some inflows into Indian debt in the medium term. And that part of the story remains. So I would say that in the near term, there would be a little bit of lack of appetite and demand, especially with all eyes will be on where the US economy and the Fed is going. But the medium term story remains intact.
And how is the bond market pricing in the fiscal end of town and fiscal management? And do markets reflect a belief that the fiscal deficit target for the current fiscal of 4.4% of GDP is achievable?
That is a very important point that you brought up, because at this point of time, people are ignoring the fact that we have been on a fiscal consolidation phase. The government has very credibly consolidated their deficit. I think they are very much on track with the budgeted 4.4% for this year. The RBI dividend only adds to some bit of buffer that the center would have beyond that. And given the expectation that the center will meet the target, the supply side of the government securities is well under control. So while there is the entire trade on rates from the inflation and the real interest rates perspective, the demand-supply dynamics are quite favorable. And at some stage when the domestic institutions look back to add duration to add those papers, I think the rate story could play out well. And from that perspective, I do believe that there is an upside to the Indian 10-year probably of another 25-30 basis points more, closer to that 6% mark from here off.